Hello everybody, welcome to the WikiTrade. So today we are going to discuss now about our session 3 of our basic course of stock market. So in the first two sessions we have discussed some of our important terms related to the stock market. First one was the structure of stock market. Then the second one was the what are the basic terms we have to use. We must need to know that while doing investing or trading in stock market. So now coming to our session 3, here we'll discuss about some key events are there. Okay, so these are the seven key events. Like key events, that means we have many key events in our personal life also. Birthday is there, anniversary is there. Okay, and some memorable moments are there in our life, like that. So when somebody is born in our family, then it brings us happiness, and if somebody depart, then it brings us unhappiness. That means they impact our life. Okay, so similarly some events also put impact on stock market, and here we have to we'll discuss about that. So first one is monetary policy. So the monetary policy is a tool through which the Reserve Bank of India controls the money supply by controlling the interest rates. The Reserve Bank of India is the central body. Okay, it regulates all the banks and all the monetary policy. Okay, so it controls the money supply. uh, Means money supply, it is a very important factor in economy. So it controls that supply by controlling the interest rate. That means if bank will increase the interest rate in FD, obviously more people will do investing in FD. If bank will decrease the rate of interest rate of FD, obviously most of the people won't prefer the saving money in FD. Okay, in the fixed deposit. So like that, that means by controlling the interest rate, it can controls the money supply. If the interest rate increases in case of FD, many people will prefer to save their money in FD. That means money is now flowing in the is supplying money is being supplied to the bank in a heavy rate. Okay, if the interest rate is low, people won't invest their money in FD. That means supply of money the is now being decreased, like that. So it has to strike a balance. That means RBI has to strike a balance between growth and inflation. Okay, it has simultaneously has to see the growth and inflation, and always there is a factor that inflation is the necessity part of a economy of an economy, because it is too much inflation is bad for economy, but in some amount of inflation, in some percentage of inflation is needed uh, for a growing economy. So to strike this balance, that is between growth and inflation, the RBI has to consider all economic factors and carefully set the key rates. So some of them we have to discuss now. First one is repo rate. Banks can borrow money from the RBI. If banks are shortage of money, then it can borrow it from the RBI. So the interest rate, then RBI won't give it to bank in free of cost. So there is also interest. So the interest rate at which RBI lends money to the other bank, that is called repo rate. If the repo rate is high, the cost of borrowing is high and leading to the slow economic growth. If RBI gives the money to the bank in case bank needs it, but there is an interest rate. If RBI increases that rate, that is the called repo rate. Okay, if RBI increases the interest of repo rate, obviously bank would prefer to borrow money from the RBI. That means it leads to the slow economic growth. So next one is just reverse repo rate. That means reverse repo rate is the rate of interest at which RBI borrows money from the banks. Also RBI also needs the money. Okay, everybody here, that may be a person or a financial institution, everyone needs the money. So RBI gives the money to bank, repo rate. Bank gives money to the RBI. It is called reverse repo rate. So an increase in the reverse repo rate is not great for the economy as it tightens the money supply. Also, increase of any type of rate is not so good for economy. If the reverse repo rate interest is also high, uh, if we increase that, it is also not great for the economy. Then called cash reserve ratio (CRR). Cash reserve ratio means every bank has to maintain a fixed amount of funds with RBI. RBI is the central body. RBI is the head of all the banks. All the banks must obey the guidelines of RBI. For that, RBI has taken uh, some amount of money from the banks. Okay, and in case of bank needs the money, in case of very urgency, RBI also help that in that matter. So every bank must maintain a fixed amount of funds with RBI. A specific share is must be reserved in the RBI. So the amount that they maintain is dependent on CRR. But how much money they have to keep with RBI, that is dependent on the CRR, that is cash reserve ratio. That means cash will be reserved at the Reserve Bank of India. So if CRR increases, more money is stocked out in the mainstream economy, which is not good for economy. So what happens here? Money is great, okay, that time when it is being circulated at the market. If it is stagnant anywhere, maybe at the bank, maybe at the RBI, maybe at our home, okay, at our locker, it is not good for economy. Okay, money has to be circulated in the market. So if bank has to maintain a fixed amount of money at the RBI, and if that amount is larger, okay, if that CRR, that cash reserve increases, then the money is stocked in the RBI. That means it is not in our mainstream economy, so it is not good for our economy. Next case is inflation. We have already said that inflation actually is a very necessary financial term in case of economy. Okay, we need every economic, every growing market needs some inflation. Okay, so it is a sustained increase in the general prices of goods and services. When we were child, we could buy a certain things, okay, in 1 rupees. Now that same thing we have to buy in 10 rupees. That means inflation is there. Okay, the cost of that product increased from 1 rupees to 10 rupees. Okay, so inflation is that sustained increase in the general prices of goods and services. As it increases the general prices of goods and services, simultaneously it decreases the power of purchase of the common man. Those who are rich leave them. But those who are common men, those who are in the lower middle class family mainly, so if the power of purchase simultaneously, if the power of purchase is being increased for common man, then it is okay. But if the inflation rate is much more than the is much more than, or is increasing uh, than the rate of power of purchase of a common man, then that common man won't buy that product. When the product was of 5 rupees, a common man could buy it. But when a product, the inflation is so much high that the price of the product is now 50 rupees. So it is beyond the imagination. It is beyond the purchasing power of a common man. So he couldn't buy it. That's why increasing inflation erodes the value of money. Okay, so it is required for all market, but at a high level of inflation, it tends to send a bad signal to the market. Yeah, in 10 years, 1 rupee become 10 rupees. Rate of one product increases from 1 rupees to 10 rupees. That's okay. But in 1 year, if the rate of a product increases from 1 rupee to 100 rupee, then it is too much inflation. It is a high level of inflation, and it sends the bad signal to the markets. So this inflation is of two types. One is wholesale price index WPI, another is consumer price index CPI. So wholesale price index WPI, The WPI indicates that the movement in prices at which the at the wholesale level. Okay, so when you can say that uh, most of us buy the grocery item or our daily products from a retail shop. That retail shop buys the products in wholesale manner from a dealer. Okay, so two levels are there: wholesale price index, consumer price index. Wholesale price index indicates the movement in price at the wholesale level, and the consumer price index, it shows the movement in prices in case in consumer level. Okay, in the retail level. So WPI captures the price change when goods are bought and sold in wholesale level, and CPI, it is the price change when goods are bought and sold in consumer level. So inflation, CPI inflation matters most. Okay, because wholesale price index WPI also matters, but that is in a means what the business persons, the middle persons, they can adjust it. Okay, because consumer also very required. Okay, consumer, they should attract the consumer. They must have to sell their products. Okay, it is being adjusted in their level by deducting any type of extra money or whatever it is. If we analyze that, if we elaborate that, we will enter into the economics, but leave that. But what affects our daily day-to-day life, that is consumer price index. Okay, uh, we the common people, we are mainly affected by this consumer price index inflation. Then coming to the next one, index of industrial production, that is IIP. So this is a short-term indicator of the country's industrial sector's progress. There are many sectors are there. Okay, many products are there, and these products are categorized into different sectors: metal sector, pharma sector, many sectors are there. So this is a short-term indicator, index of industrial production. This is the indicator of country's industrial sector's progress in 10 year, in a decade. In this sector, how much our country progress. This shows that. So data is released every month along with the inflation data by the Ministry of Statistics and Program Implementation, MOSPI. And for better clarification, you should visit the website also. Okay, nowadays each and every department of government is presenting a very clean data. Okay, so month to month basis, you can see that this month which sector progress rapidly, or which means how much progress has done by which industry, by which sector in this month. You can see that along with the inflation rate. So if this index of industrial production increases, that means it indicates a vibrant industrial environment. Okay, that means in that sector is going up. Hence, a positive sign. It is the positive sign for economy and market. But if the IIP, if the index of industrial production is showing a sluggish production, okay, or sluggish production environment, that is a negative sign for the economy and markets. Those persons who are involved in any type of business, if any shopkeeper also, if somebody of you is also a shopkeeper, then also he or she can understand what I mean to say that. Suppose you open, I am considering, I am giving you a basic example. Suppose you opened a shop today, okay, this month, and your production selling is increasing month by month. Okay, for 6 months you increase the production of selling, the selling part increased month after month. But after 6 months, you saw it stagnant. In July, 100 products sold. In August, 100 products sold. Or in September, 102 products sold. In October, 98 products sold. That means it is now coming to a stagnant. So this is called sluggish production environment. Okay, either decrease in the production or the stagnant level of production. It is called sluggish production environment, and it is a negative sign for the economy and market. If you see the economic newspaper or economic website, whatever it is, you can see that this financial year or this quarter, uh, this metal industry produces this much ton of cast iron. Okay, so if the production level is increasing month by month or quarter by quarter or year after year, then it is the progress of index of industrial production, progress of IIP. That means our economy is growing. But if that production of ton is getting similar quarter after quarter, then it is or decreasing down, then it is called sluggish production environment. Clear? Now going to the Purchasing Manager Index, PMI. So the Purchasing Managers Index is an economic indicator that tries to capture business activity across the country's manufacturing and service sector. So this index is a type of economic indicator that captures the business activity across the country's manufacturing and service sector. And this is actually mainly a survey based indicator. Just remember that if PMI number means actually PMI number oscillates in between 50 around 50, that means 40 to 60 or 45 to 55, around 50 it oscillates. If a reading above 50 indicates the expansion, below 50 indicates the contraction in case of in the economy. So, and if it is 50, then there is no change in economy. Okay, it is the simple manner. We need not to dive into the so much deep into the economy. Just remember, 50, exact 50, no change of economy. Increase more than 50, it is the expansion of economy. Less than 50, it is the contraction of economy. Next one is budget. So a budget, everybody knows budget. Okay, mainly whoever also doesn't know about budget means used to not knowing about budget. Here she also knows this budget nowadays, because we are so habituated now to know our economy of our country. So a budget is an event during which the Ministry of Finance discusses the country's finance in detail. Now, our Honorable Minister of Finance, Mrs. Nirmala Sitharaman. So the day she is discussing, she discusses the country's finance in detail, and the finance minister on behalf of ministry makes a budget presentation to the entire country. And that means in that budget session we will know that various sector, like how much our government takes from the means takes from the citizen, and in how many ways and in how many percentage it spends that money for our country. It is a detailed expansion. And there is the income tax slab. This is also included in the budget. It is being discussed here. Okay, so during this budget, major policy announcements and economic reforms are announced. Many policy announcements, you can know that I am not saying that means for this state, this is a very populated scheduled tribe state. So special compensation, special amount of budget is allocated to that state particularly. This is a community, and this is very backward community, so Minister of Finance will allocate a certain amount of budget to that community. Okay, to defense sector, to railway sector, like that. So it impacts various industries across the markets. For medicine sector, means special announcements are there, and depending upon that, our economy grows, shows a very vibrant momentum at that on that particular day. So therefore, a budget plays the vital role in case of the economy. And then comes the corporate earnings announcement. Corporate earnings season is one of the important events to which the stock market actually reacts. So the listed companies, that means the stocks which are being traded in the stock exchange, they must declare their, it is the SEBI guideline, they must declare their earnings once every quarter. That means once in 3 months. Uh, Also, that is called. quarterly earning numbers. Okay, so when in the next session we will go to discuss about the fundamental analysis of a company, and then you also do, in case of practical things, you should um, means you should see the details of a company, and there you will see that company are announcing in every once in every 3 months, once in quarter, that how much they have gained or how much they have lost in revenue, in profit. Okay, all the detailed number you can see there. This is called corporate earning announcement. Then non-financial events. Stock market is totally financial topic, but okay. So this financial topic is affected by um, many financial data or many financial events, but it is also affected by many non-financial events, because that non-financial effects affect the common man purchasing power, common man finance. Okay, totally a economy of a country. So what are that? What are those non-financial events? That is the geopolitical issue, like war, pandemic, like corona, etc. They are some of the examples of non-financial events which affect the stock market drastically. You can see that whenever the stock market crashed drastically, in corona, in Lehman Brothers, in the Satyam computer. Okay, so geopolitical war, when the Russia-Ukraine war started, you can see there is a drastic fall in market. Okay, so there are also some non-financial events which affect our stock market. So this much was for our session 3. So this is the end of session 3, and in the next session, our fourth session, we will discuss about the fundamental analysis of a stock. And here I want to means add something. Okay, word. Sorry, this much.